Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. And yes, we are on our new thing. 2 times a week episodes are getting released, Monday and Thursday. Not Wednesday anymore because we upgraded thanks to you. My guest this week is Chad Zdenek of CSQ Properties. We go into a deep dive about passive income, how to get freedom from it, syndications, GP versus LP. I can't wait for you to hear this episode. If you're liking the podcast, do us a favor, review it, follow it, subscribe to it, share it with your friends. Let's get to the show. This is episode 58 of Zen and the Art of Real Estate Investing with my guest, Chad Zdenek. Chad is a registered professional engineer, licensed general contractor, former CEO of Mobile Illumination. His company, CSQ Properties, acquires, repositions, and manages multifamily properties throughout the United States. Chad, welcome to the show.
Thanks, Jonathan. Super glad to be here. Thanks for having me on.
Yeah, excited to talk to you. So before you got into real estate, when you were younger, did you have an interest in real estate? It's always where I like to start.
Sure. So my interest in real estate would have been from construction. So as correlated or related as you'd make that, I loved construction growing up. My dad, I always like to say, was a contractor who did eye surgery on the side because he was always doing construction projects and I was helping him out a lot and then started working for other contractors. Obviously studied civil engineering, got my contractor's license. So that was my relationship to real estate, and then purchased my first investment property in 2015.
Yeah. And so it's funny, though, that you said that because I had a dad who was an investor whose side job was being a lawyer. So I understand. But it's interesting. When you got into contracting as a profession, were you thinking investing at all, or were you just thinking like, I really like to build things?
Yeah, it was definitely more the latter. I loved building things. I liked the planning process, just watching things come to life, if you will. And when I was getting my undergraduate degree in the 90s, I worked for a large construction management firm working on big commercial projects. So that was exciting. And I really wanted to study construction, but there really wasn't construction management studies like you might have today.
Yeah.
So the closest thing they had was really the civil engineering. And that's why I decided to go into civil engineering in the 90s.
Yeah, I always ask because I think there's people who get involved in real estate related fields, but especially back then, it's not like there wasn't the proliferation of social media where everyone was investing. Exactly. It's the 90s. We didn't know about that. So when did you first decide, look, I also want to start investing?
So that really happened kind of partway through my career. So I've kind of had three career chapters in my life, if you will. So the first was I worked at Rocketdyne on the space shuttle main engines, did that for 7 years.
Oh, awesome.
Yeah. And then I left to go run a business with my brother, very small startup. That was Mobile Illumination. And it was really during that business where we worked with a lot of high net worth clientele, where I started seeing a lot of financially successful people that had made a good amount of their money in real estate. And so that started to get me interested on the real estate side more so than the construction side. And then as I kept kicking myself, I got to get into real estate. I got to get into real estate. And eventually when I sold the business, I'm like, this is my chance. I'm going to do it full time and jump into real estate. And that's what I've been doing ever since.
Yeah. Do you think that with you guys having that business, the mobile illuminations, did that help you with the entrepreneurial part when you went into like investing, knowing like, actually, I'm going to do this as a business? Whereas some people who are like brand new to investing, they're just thinking like, well, I'm going to get a house hack and, that sounds great. How did you go into it, at that time when you thought investing? Because you said you're going in like full time.
Yeah, I've always been an entrepreneur my whole life. And actually, when I was working at Rocketdyne, who was bought out by Boeing, that was more of like an anomaly. I'm not really a big corporate guy, but it was a great experience, great projects I got to work on. But I've always been an entrepreneur at heart. When I got my MBA over at UCLA, I was focusing on entrepreneurial studies, kind of helping my brother, grow the business at a very early stage. And coincidentally, I was there for 1 year. Me and both my brothers were at UCLA at the same time. They were both playing football over there,
Oh, cool.
and I was getting my MBA. So it was great to be there with both my brothers, focusing on entrepreneurial studies. And then that's when I'm like, I'll take the leap. My brother really wanted me to come work with them on the startup, and so I left Rocketdyne to go do that with him. But I've always had this entrepreneurial spirit. Some of your listeners may have heard of an organization called the Entrepreneurs Organization. I've been a part of that for 10 years, and I've either founded or helped found 8 different companies now. So it's really in my DNA, the entrepreneurial side of it.
Yeah, and don't you think that's something really baked into a lot of other big investors that because it takes a fair amount of like educated risk. So you have to have that spirit in you to be able to succeed long term, because not every deal is going to be a winner. You have to think long term versus short term, which is what entrepreneurs know well.
Yeah, absolutely. And I'm like a double dose of that because I'm an engineer and an entrepreneur. So in terms of like
Yeah.
risk mitigation, risk analysis, like that's really baked into my DNA. Maybe a little bit too much, you get the whole paralysis by analysis type of setup.
Yeah. Yeah.
But that's really
Yeah.
what it comes down to, right? Is mitigating risk and kind of thinking of the outcomes, making a move when you don't have 100% of the information in front of you. For me, generally, if I get to 80%, I'm usually pretty good to go to make a move. Yeah, the entrepreneurial side of it is definitely, I think, a big part of it is risk mitigation.
Yeah. Yeah. I agree. So what did you first get started in? You obviously going in, it's going to be real estate, but how do you get started? What kinds of properties were you looking at the time?
So I had bought 2 properties. I mean, I bought 2 houses on my own, primary residence, but I don't really count that. But my first investment properties were in 2015, and I'd actually purchased a medical building from my dad. My grandpa actually built it in 1952, and then my dad bought it from him in 1986, and I bought it from my dad in 2015. So
Yeah.
that was my first property. And then once I sold the business in 2018, 2019, and I went into syndication full time. So basically working with investors, pooling money together to buy a property. And so I'm in Los Angeles, and I wanted to buy things kind of closer to home. So I was investing in Long Beach, and that's where I bought multifamily properties via syndications. I was, of course, investing in them myself as well, but pooling other investors' money together to take down those properties, and that's how it started.
Yeah, was that like a SoCal thing, knowing, or I mean, a California thing overall? Like the prices are just so high for and the cap rates are so compressed for real estate that you really have to go syndication if you want to go bigger.
Yeah, definitely. The other piece of that puzzle is value add deals, right? Where you're fixing up a property to increase the appreciation, what we call forced appreciation. And there's a lot of old properties, especially in Long Beach. So my properties ranged from 1930s build down to like a 1911 build. So definitely older properties, pretty heavy value adds. They needed to be upgraded. But if you do that right, you can create some good appreciation. And believe it or not, they do cash flow. These properties were 2018 to 2021, probably when I was buying in Long Beach. And it was a great debt environment. We got super cheap debt on it.
Yeah.
And so, yeah, they do cash flow monthly, but there's appreciation play also with the rehabs.
Yeah, for sure. And did you end up holding those, or have you sold some of them?
So my Long Beach buildings I've held on to. I have sold other properties in SoCal, but for those ones I've held on to. And you might have heard, the idea that now people are, the debt is the asset, right? So if you've got
Yeah.
good fixed debt, that becomes the asset of the property. I know a lot of homeowners are experiencing that, and then their 3%, 30-year fixed mortgages they have. Like, it's really difficult to move when you've got that kind of mortgage. Well, the same is true in the commercial
Absolutely.
space, right? I mean, it's like we got our lowest is a 3.1%, 5-year fixed loan on a commercial property. And now you'd probably be, at least 300 basis points higher to do something today.
Yeah.
So, and that really eats into the cash flow if the price doesn't adjust accordingly. So right now we're good on cash flow, and investors are happy with that. So am I.
Yeah. When you started building these syndications, you had said before you had seen all these people with net worth. They were involved in real estate. Were those some of the people that you went to first, and in addition to people that you knew? Because I think people, when they're starting syndications, part of what they're trying to figure out is, who do I go to and how do I not necessarily sell, but like, how do I make this an attractive proposition for other people?
Yeah. So the people that I initially saw, I saw them like from a work standpoint, right? They were clients of mine. So,
Yeah.
and at the level that we were operating at, I mean, these were like the billionaires of LA, basically. So we very rarely would interface with the owner directly. Usually it was their manager or the house manager or
Yeah.
assistant manager. So it got down pretty low in the hierarchy before you're talking to the
Yeah.
to the workers.
Yeah. Yeah. Yeah.
Yeah.
A million. That's still 4 levels
Oh
down.
my God. And really, I mean, you'd have like several levels just to run a house. It's
Yeah.
crazy. So yeah, so those were the people we were working with, and none of those people were investing. But I could see the idea. I could see how it came together. And we've all heard like the power of real estate, right? Like the best get rich slowly scheme out there, the tax advantages, the leverage, right? And it's, I like to say it's a lot like riding a bike. Like, unless you're actually doing it, you read about it, you think about it, like, you don't really know the real power of it until you start to see the monthly cash flow come in. You see the tax savings, you do your tax return, and you're like, wow, I can't believe I'm not paying any taxes on this right now. And that's where it
Yeah.
really clicks, even though I knew about it, but I wasn't living it until I did it on my own.
Yeah, and do you think that would have been harder if you didn't really sink in full time when you left your other job? There's so
Oh,
many
for
people who,
sure.
try to invest part time, they get a few properties, and then they realize now they have 2 full-time jobs.
Yeah, I think, and it really depends on how you're investing, right? I think we might be getting into this later, but like the limited partner versus the general partner, right? So
Yeah,
you can do your normal job or whatever you want to do as a limited partner, right? There's very little involvement you have, and that's really like the holy grail of where people want to get to, right? Is to be able to invest passively, not deal with the headaches. They take a little bit smaller cut because of that, but it's passive, right? And they can do their passions, they can do their W-2 job, they can run their businesses, whatever they want to do. On the general partner side, which is like my side, I'm the one that is, running the deals, searching for deals, securing the debt, getting the equity together, managing the property managers, the construction, blah, blah, blah. There's a lot of stuff. And that's a very full-time job as a
yeah,
general partner. I do invest passively, which is great. But on the GP side, like, you really got to be doing it as a full-time job.
yeah. Or I mean, you'll let down all the LPs if not, and then
Yeah.
there's going to be problems. Would you agree with me? I always say that that most real estate that people consider passive isn't really passive, but when it comes to LP, I do think to me that is passive real estate investing, LP, because you can't really have input. If you know the GP, you might be able to get a little extra information, but generally you're just getting your monthly updates, and banking on the asset as a whole. But I find it funny that other people classify like multifamily as passive. It's like, that's not even close. Like, LP is really passive because you can't really control much. How much info do you guys give to your LPs? Is it in a monthly, or what's the dissemination of information for that?
Yeah, it depends. And by the way, I would totally agree with your sentiments there, right? It really is passive. The work that needs to be done if you're a limited partner is just upfront. evaluating
Right.
the GP
Due
team,
diligence. Yeah.
evaluating the asset class, right? Due diligence markets and so forth. Like you do your work up front, and then after that, it really is passive. So that's just a sidebar to that. But so I agree with you there. And
Yeah.
what was the question again? I apologize.
Yeah. How do you disseminate information
Oh,
to
yeah.
your LPs when a deal's active? Like, is it a monthly or do they have a portal? I think people are always interested. Like, if I'm going to get into an LP, maybe some people don't want any, but some people like at least want a lot of information. So how do you guys deliver?
Yeah, we always try to err on the heavy side and then let people self-select what they really want.
Yeah.
So yeah, we have like investor portals they can log on to. All the documents are there. We generally give monthly updates, but when you get into these stabilized deals where there's not a whole lot going on, and then it might be
Yeah. The value ad's complete.
yeah. I mean,
Everything's
it's
just
just like
running
rents are
smooth.
coming in. There's no issues, right? You're not doing construction. The loan is set. There's very, very little updates month to month. So for those types of properties, we might move to every 2 months or quarterly. But certainly when you're doing construction or when you're in the stabilization phase, meaning you're leasing properties, leasing units up and whatnot, the
Yeah.
updates are a lot more often, and it could even be twice a month. But typically, once a month is about right.
Yeah, you said something important in one of the last statements when we were talking about that initial part of due diligence. You talked about vetting the GP. To me, that's something, especially now, that's so important because there's a lot of GPs out there who they don't really know anything because you can make something look super shiny now, and maybe people are into that and they don't know the background. If you're when you do go in as an LP, what are you doing to vet GPs to make sure that they have the background and especially the finances to control so there's no like trickle down effect to LPs if something goes wrong?
Yeah, so that's a good question. And that, frankly, is where I put most of my effort when I'm an LP. I put more of
Yeah.
my effort into vetting the GP team than I would the market. The asset class is a
Yeah,
fair
I
amount.
agree.
That's broad brushstroke. But
Yeah.
the reason why is like in real estate, there's always issues that come up. Like it doesn't matter the deal. There's always
Yeah.
issues. So the question
Yeah.
isn't is there going to be issues? The question is the GP team going to be prepared from an experience standpoint to handle those, and also from a transparent standpoint, a trust standpoint, to handle those issues when they arise. So I spent a lot of time vetting the GPs. And then, like you mentioned, the financial backing is pretty important, especially in this environment where things are
Yeah.
changing a lot. You really got to pay attention to that, pay attention to the debt on the deal. But certainly knowing the experience of the team is critical.
Yeah. And I like what you said because I also am much more interested in vetting the GP than the locality for myself. But you also want to know that the GP has the experience in the locality because if you're talking about apartments and it's your first, 100-plex in Houston and you don't know how it works in Houston, like it's going to take way, way longer to finish the value add. So like the way that I look at it for local, I'm like, I want to know who's done multiple in that area because they have the connections, people have worked with them, and then you can get all the deals that you want, especially better services. Do you agree with all that?
Yeah, 100%. So what I was saying, like getting to know the GP or trusting them, like you're trusting their experience in that market, right? Their knowledge of the market. I'm never going to become an expert in XYZ market like they would be, right? Like they're
Right.
the partner, and you're really relying on them to do that. So that to me is critical to a successful deal.
Yeah. So what asset right now are you most interested in acquiring for your group and for your investors? Like what are you looking for like right now in today's market? We're recording late June right now.
Yeah, so I've been pretty bullish on multifamily for a long time, and more recently I've been diversifying a bit more into self-storage.
Mm,
Self-storage tends to do really well during recessions, and also with some of the tenant uncertainty with respect to tenant laws that are changing. I like
yeah.
self-storage from that standpoint. So I'm diversifying a lot more into self-storage and also between different states, right? Like states are continually changing the rules, some more than others. And so I think it's pretty important to be spread out between different states. So that's what I'm doing for myself and my investors.
Yeah, I think self storage is a really smart play, especially with what you said. There's tenancy issues always. I mean, and you talk about, during the pandemic, there were major tenancy issues. I think a lot of us did really well because we were good landlords, but bad landlords got crushed during that time. What's the greatest thing about self-storage? No tenants and like limited water.
Yeah.
I mean, not much bad can happen. Construction's usually metal or block. Everything's like fine. Yeah. Do you find that the investing pool that's out there that's looking to invest with you thinks that that's a safer asset as well, just from in terms of who wants to get in on that?
I would say yes. And generally, people really like the idea of diversifying, especially when you're talking about repeat investors. So a lot of my investors repeat with me on several different deals.
Yeah.
And for those investors, yeah, then diversified portfolio becomes really important. If you're just like a one-off investor, then it's, you're not looking for that. But the people that are like more serious, like let's say like the serious passive investors, they like being spread out between asset classes and different states and locales.
Yeah. I think that, diversification is so important across just investments, but I think people forget that you can be just a real estate investor. You can pass on stocks, even though you should. I like investing in stocks also. I like startups. I like all that stuff. But like real estate itself, you can be completely diversified just based on what you're saying. You can go self-storage. You can go mobile home parks. You can go large scale multi, small scale multi. You can do flips. You can do all these different things, Airbnb, that you can be just, quote, a real estate investor, but be completely diversified real estate portfolio, which I think some people forget. What's like next on the horizon for your company? Do you like where you guys going, or do you have plans to go even bigger type of assets?
Yeah, so I made a transition a few years ago into bigger assets. So originally when I started out, I was just doing my syndications as a solo GP. There was no partners. It was just me and then limited partners. And I've since changed that strategy to do much larger deals out of state with partners. And you can't partner on small deals, right? There's just not enough meat on the bone. So on the smaller, like $2 to $3 million deals I was doing here in LA, those deals was just me and investors, right? But now I'm doing these larger deals out of state. And in order to really tap into that knowledge base that I'm talking about with partners, you just have to do larger deals so that it can afford everyone's expertise on the deal. So that's the biggest change that we've been making. Alongside with those bigger deals are also like out of state deals. So now I'm probably in 5 different states now. And I really like that, especially you just don't know what's going to happen with landlord rules. And
yeah,
I'm an engineer. I'm an MBA finance guy. Like I do a lot with underwriting, but you can't underwrite to legislative changes, right? I call it
exactly.
legislative liabilities, right? Like how do you just can't include something like that in underwriting. Maybe you can for the next 6 months or something like that, but on these maybe right, but on these typically like 5-year holds, like there's no way, you just have no idea. So because of that, I like to get in these more stable legislative environments, at least on the multifamily side that we're talking about right now, to where I feel like there's going to be less legislative liability. It's more certain to know, at least for the near term, what's going to happen in 5 years, and investing in those types of places. And I've had a lot of minefields in LA and SoCal, right? Like,
oh yeah. They
I've
like to throw some changes.
Ooh,
yeah.
Let me tell you, they can throw some curveballs at landlords out here. So I definitely cut my teeth, I think, in like a pretty tough spot. But I do like investing out of California.
Yeah, those are good points. I think that you're just trying to figure out all the things that will work for you as an investor, as a syndicator, and then trickle that down, to the investors. But you made a great point that there's only so much you can do with the due diligence. Like, of course, your numbers have to work and the spreadsheet has to look, but you also have to know things outside of the spreadsheet. Like you're saying, you can't predict, legislative anomalies that are coming, but you can know population patterns and growth to judge things that can't be quantified in terms of like rent versus what you're paying. Do you think that sometimes like people are too focused on the due diligence aspect? Maybe as an LP, that's smarter. But I'm the same as you. I like to know a little bit more of the other things. I feel like you can be a better investor like that.
Yeah, I mean, maybe it's the engineer in me, but I don't think there really is too much due diligence that you can do. Like I said earlier, I don't have to get to 100% certainty, and frankly, you never
Yeah,
do.
yeah.
So you do have to make a leap at
No.
some point, right? For me, it's about 80%, but I there's a lot of people that don't even get to 80%, right? I mean,
Yeah,
they shoot from the hip a lot more than I would be comfortable with. So I probably err a little bit more on the heavy side in terms of the amount of due diligence, and I'm okay with moving a little bit slower if I have to. But on some of these deals, like especially when we were in the earlier market, now you've got some time. But in a seller's market, like you got to move, right? If you don't move, you're just not going to pick up the better deals. And you got to understand that there's a cost associated with not moving quickly. So it really
yeah.
depends on the market, on kind of what amount of time you have and how hard they're pushing you. Right now, you've got a lot more time to do things, right? Your contingency periods can be longer now. The negotiations with the seller are a lot more open. You didn't have that 2 years ago. So it's a different
Yeah.
environment, and it's always changing.
Today's show is brought to you by Streamline Properties on Market, brokered by eXp Realty. That is my on-market real estate team. We are investor friendly. We work traditional buyers, sellers, but we also work the investor sphere all the time. House hacking, short-term rentals, flipping, long-term holds, anything that you want to do. We're experienced in that arena. We work the whole state of New Jersey, Philadelphia County in Pennsylvania, Elko County in Nevada, and the Catskills region of New York. So whatever your investor needs are, you can count on us. You can go to streamlined with a D properties. Let's get back to the show. With what you're seeing, actually, let me start with this because I was going to ask you this. How are you choosing your states right now? Because I think that's always interesting for just investors to learn how everybody chooses. Okay, like I'm finally going to go outside of my backyard. What things are you looking for? Is it partnerships or is it data that takes you to another state?
So it's a really good question. I think the broad brush strokes in terms of like states, I would look at states first and then a partner within that state, right? So, I mean, there's partners that invest in every state, obviously, in the US. So
Yeah,
I could have a great partner who's like investing in New York right now, but that's not something I'm really interested in, even though the partner could be really, really good. So I would look at the state first. And for that, it's really, it doesn't change a whole lot. We're looking for population growth, income growth, and job growth, right? I mean, it's
yeah,
been those three
yeah,
for a long time. And it's like, you don't need to get too fancy. As long as you got those three tailwinds, like you're really setting yourself up for success in real estate. So you can look at population maps to see where the migration patterns are happening. I think we all kind of understand where people are moving to. And so those are generally the states that I'm looking at. And then within those states, I would drill down to work with operators that I know that are doing deals in those states. Because I'd have no idea whether to invest on this side of the tracks or that side of the tracks
yeah,
in a city, right? So I really have to rely on a partner. Generally, it's a local partner who really knows the market, and they're looking for other partners to help build out the team. They know the nuances of that locale. But like, for instance, I know that I wanted to go to Florida, right? We've been doing a lot in Florida. So I'm working with partners who are local to Florida, and knowing that I'd rather be in Florida than New York, for example.
yeah. You mentioned migration patterns, and I thought that was interesting because California obviously has had a lot of outward migration. So are you following those patterns a little bit just from people in California? Because those markets have sent subsets of investors and people to other markets, wherever they may be, Dallas, Salt Lake, depending how far people want to go. But there's definitely been over the last 3 years some pretty telling migration patterns just out of California.
Yeah, absolutely. And I'm living and breathing that, right? I mean, I between my family and my wife's family, we've had 37 family members move out in the last 4 years, move out of California.
Oh my
So
gosh. Yeah, yeah.
I'm
So that, I mean, this
yeah,
that
37, right?
that's crazy.
And you could guess which states they went to, right? They went to Idaho, they went to Arizona, They went to Texas and Florida, right?
Yeah.
I mean, like we know that's where people are going. So, I'll
Do
tell
they have a
you,
shuttle to Boise? They must have a shuttle to Boise and Scottsdale right now. I
yeah.
think it's just like direct.
Well, and it's crazy. You know what you can also do? Like the people that really want to do some due diligence, dive into the U-Haul rental rates between cities, right? Because they rent
That's
them.
smart.
Yeah. So you can look into that, and you can also look into the reservation timeframes, right? If you want to move from Vegas to LA right now, you could get a U-Haul tomorrow, right? And it's going to cost you about $200. If you want to go from LA to Vegas, it's a 4-week rate, and it's going to cost you about $2,000.
Yeah.
So that's like anecdotal evidence that's very telling if you really want to see put their boots on the ground, or you just like people like me that, hey, I've had 37 family members move out, right? It's like that's what's happening. So I think that's very telling. So then you ask yourself, like, okay, Chad, but you invested in SoCal and you're keeping most of your properties in SoCal. Like, why aren't you selling and moving all your money out, right? And so that you got to look into it a little bit more. It's like peeling back the onion. And then you got to look at, okay, well, what kind of inventory is coming on board? Like, what are the building permits look like? What areas can you develop in LA? Right? Like, we're really really overbuilt in LA, and it's very expensive to build. So those are two huge barriers to entry for new inventory. And yes, California is losing people for sure, right? In terms of population growth, but we have so little inventory that's coming online that it's not keeping up to pace for what's needed.
Yeah.
And that's part of the reason why there's high demand, right? And then you overlay rent control onto that, right? And permit costs and regulation from that standpoint, where people don't want to build because it's too expensive and the rent control's there, so they're not getting the returns. And you have this perfect recipe for a very, very low inventory environment where there's still demand and prices are increasing. That's why you have the equity play here in a place like SoCal, and cash flow is low.
Yeah. Another thing I wanted to touch on, because you brought up Florida, you've been getting into Florida as well now?
Yeah. So right now I'm in St. Petersburg, Orlando, and Jacksonville. I've got about 10 properties out there between those three cities.
Yeah, so I lived in Florida for 14 years. I lived in Fort Lauderdale for 7, Sarasota for 7. Loved the markets, did a bunch of investing while I was there. Have the new increase in insurance rates caused any issues with your properties? Because that's, when it comes to Florida right now, everybody's talking insurance, like insurance companies are just being like, it's insane.
Yeah.
Or you can just cross factor that in over the long term, because it's definitely an issue now, right?
It's a big hit. It's a big hit.
Yeah. Yeah, that's what I've
you're
heard.
getting insurance rates that were doubling, and you might have underwrote to like a 5% or 10% annual increase, right? So that's a good example of something that wouldn't have been captured in underwriting from years ago. So yeah, that's definitely a hit for sure. But on the flip side, like the rent growth is much higher than we were projecting. Vacancy is still really, really low. So overall, the deals are doing really well. But insurance is one of those big hits that we're taking right now. And some people are really scaling back on investing in Florida because of the insurance. I mean, it is out of control. And even you talk about legislative changes, right? They're trying to curb some of those increases. I'm not sure if it'll end up going through or not, but the Florida government is trying to get some of that those increases under control. I don't know if they will or not, but it's a big hit right now.
Yeah, but I mean, there's something to be said for it. I think anytime everybody, I've talked about this on a few different podcasts, and we always say if somebody's running away, a lot of us savvy investors are like, I think I'll run towards that, see what's there. Maybe I'm not going to take all the deals, but like, yeah, the insurance premiums are going to kick some investors out, and they're going to have to sell because the premium will push them over. Numbers won't work for them. That means a potential deal, on the other end. Same with California, like you were saying. There's no inventory, so why would you sell properties? You could, because you're at a high value, but there's no indication that that's not going to keep going up.
Yeah.
Where you are.
Yeah, I agree. And the other big one we haven't really talked about in terms of running towards the fire, if you will, is interest rates, right? I mean, it's really, these higher interest rates have really softened the market. For me, and my investors, we're buyers, currently buyers, and I'm getting deals on stuff that I wouldn't have gotten a year ago, right? We're getting retrades and discounts on asking prices that were unheard of. In fact, we got a deal in Dallas that we're doing right now, a Class A building downtown. We're buying it cheaper than the seller bought it for in 2019. So
Wow.
for investors that's saying, oh my gosh, like I wish I would have bought before COVID and I missed this big run up. Well, now's your opportunity. like if you can find a good deal, you can find pre-COVID pricing right now. People are saying, oh, I'm just going to wait until interest rates come down. Well, I'll tell you what, if and when interest rates come down, these prices are going to skyrocket. It's going to blow through the roof,
Exactly.
and you're going to miss the boat again.
Right, but that becomes what I call the double windfall philosophy. It's actually a triple windfall if you account for what you're saying. If you buy now with a high interest rate and you have the intent of sticking it out until the rates come down, then the rates come down, say it's 2, 3, 4 years, and then you refinance at that time and you get the bump of now rates are down, so your appreciation is still like really scaling up high. You get the double windfall at the same time. Your payments shrink, your appreciation comes up, so you can try to take out all your money at the same time. And that's how investors think. I even tell that to homeowners, though, that the double windfall's there. And they're like, oh, you're just trying to sell me a property. I'm like, no, it's really going to happen that way. But that's a great point, because when the rates come down, those prices are going to go up. It's area specific. I mean, I live in New Jersey. The real estate market's still insane. It's been insane for a while. It shows no signs of stopping anything. But that's residential. Commercial's a whole different story now, I think, everywhere. Have you found that finally, from what you were saying with that Dallas property, finally the commercial sellers are getting it, that they have no way out? They're going to have to sell, because on a couple podcasts, I talked to Ashley Wilson, Jay Scott from Bar Down Investments, and they both said at some point there was like this disconnect with what these properties are worth, and these owners were still 10, 15% higher. But now it looks like they're going to get it because it's not coming back to them. So they need to get it now if the numbers don't work. Are you seeing that as well?
Yeah, 100%. And I think it's important to distinguish when you say commercial properties, what type of commercial properties are you talking about? Because multifamily is very different than office or retail, right?
Yeah. In your context, I was talking large scale multifamily. That's where the diversion was.
Yeah.
I think all commercial, the other traditional commercial office complexes, we all know they're in trouble.
Yeah.
Those owners are in trouble. They have been since the pandemic. There's so many unused spaces that people are going to have to figure out what to do with. So yeah, those are different. Was your Dallas deal, was that apartments or was that commercial?
Class A apartments.
Oh, right. Yeah. Okay. So that's what I was talking about.
Sure.
Because I feel like apartments still have the income coming in, so they can kind of wait it out longer because they're still going to be okay. But like what we were saying, those offices, like they don't have, you could have 80,000 square feet vacant right now and nothing on the horizon to use. Are buildings like that interesting to what you guys do for redevelopment?
Well, I'll tell you, it's kind of interesting because I think you and I have a similar philosophy, and Warren Buffett for that matter. But when there's blood in the streets, right, even if it's your own, it's time to buy, right? So I always ask myself, like, okay, there's a lot of blood in the streets with office and retail, right? So being a contrarian investor, trying to have that perspective, like, okay, should I be looking more seriously at office and retail? Because there's streaming deals right now, right?
I think about it every day. Yeah.
But I can't get myself to come around to it, right? It's like,
I'm the same.
You talk about like catching a falling knife, as they say, and I don't think office and retail have seen the bottom, anywhere near the bottom.
I agree.
And I'll tell you a big thing people don't talk about when they talk about office vacancy. No one's really talking about office underutilization, right? So you've got these companies that are still making money and they're still paying their 5 and 10 year lease, right? Whatever the lease is, right?
Yeah.
So on paper, that's an occupied office, right? But in reality, and in terms of the bank, that's an occupied property. But in reality, that company is not going to renew the same amount for that lease when that 5 and 10 year debt comes due. And we've got over $1 trillion in the next 12 months that's coming due on these loans in the office.
Yeah, absolutely.
So that I think is going to really shift the numbers a lot. We're talking about, LA's got a 30% vacancy in office right now. but it's not utilization rate, right? I would, and I don't know what those numbers are, but I know the utilization rate is a lot less than 30% vacant.
Yeah.
And that's the
Yeah.
real number. So in my mind, yeah, there's blood in the streets on office and retail, but I don't feel comfortable going into that right now for me personally as an investor. And you can still find great deals in multifamily. And like you mentioned, like, are buyers coming around? Like the short answer is yes, they finally are. On that deal that I'm talking about in Dallas is a Class A multifamily, and we're buying it for less than they bought it for in 2019. But they want to get out because they're on bridge debt. The bridge debt's coming due, and the rates are way higher than what they thought it would be. And so they need to sell. So for them, if they can sell with like minimal loss and get all their investors just the principal back, that's a win for them in this environment. For us, we're getting in at 2019 pricing, and it's a win for us because it's like you're talking about on changing the debt. They say you marry the property and you date the debt, right? So get a good property at the best price you can, and then hopefully change the debt later. Like in this deal, it's a 5-year hold, but we have 7-year fixed debt on it, right? So we've got two or 3 years of runway just in case, right? So we're really 7 years out before we have to worry about it. And for us, that's a big win. And plus, it's a value add deal anyways. Even though it's Class A, we got about half of the property we need to improve on. So I always like to have value add in there because that's how you're getting forced appreciation right away, regardless of what the market does.
Yeah, that utilization point was fantastic. I just feel like that's something that people aren't thinking about. Sure, it's exactly what you said. No one's renewing those leases because everyone's still working from home. No one even wants to come back to the office. People are fighting it. The companies with thousands of square feet of office space, those are all subleased, if they can, or vacant. What happens when all those leases come due? Yeah, maybe that's the bottom. Like maybe there's a little blood in the street, but we're waiting for red wedding. It's just like, that's what you look at. I look at those all day. The only thing that I would be really interested in vacant commercial now is for redevelopment to residential, which I think is a great play, but it's, neighborhood local dynamics on whether or not they're going to allow it.
Yeah, it's also very expensive. I don't think that code's been cracked yet, right? I think it's going to need more government influence and government support on that, just because the construction side of it is still cost prohibitive. Yeah. And I'm not sure how that's going to be figured out yet, but I agree with you. I think once that code gets cracked, I think there'll be a lot of opportunity there. I just don't see it happening without some government intervention.
Yeah. Quickly before we hop off, I wanted to touch on one thing that you had on your sheet for the pre-intro. It's about masterminds, because when you went in full time, you got into masterminds. How much has that helped you as an operator and investor over the years? Because it's something we like to tell to newer investors, like you need to find masterminds, and then they just get bigger and bigger and bigger, along the way. How much has that helped you as an investor?
Yeah, 100%. And I think it's really, you can use mastermind groups either as an operator or as an investor, right? It's not exclusive to one or the other. It's really good for both. And what it does is it really, in a nutshell, it compresses timeframes. So if you want to get from point A to point B, and you're a halfway smart person, like you can figure it out and read books and listen to podcasts and go to classes, all this stuff, that you can do that, right? But it's going to take you a long time. It's going to be a lot of work. Whereas if you're a part of a mastermind group, you can learn very quickly, right? And also by establishing these relationships and getting back to the idea of trusting people and meeting partners. Like if you meet somebody in your mastermind group, you're already at a certain threshold where like they need to kind of watch what they're doing, right? They don't want to shoot themselves in the foot inside of a mastermind group, because then they're going to be, blackballed. They're going to be shut out from the group. So it really helps a lot from that standpoint. I'm actually a part of 4 different mastermind groups. They all kind of help in different aspects of things, but I highly recommend it. It's an investment like anything else, right? You got to pay for it, but don't think of it as an expense. Your audience should think of it as an investment into their learning and compressing that time frame to when they can get up to speed and take action.
Yeah. And I much prefer the idea of like a mastermind where not necessarily everyone's at the same level, but it's not like a guru thing. Like you're all in it together in a mastermind. Somebody's running it, but like you're not getting hard sold on, well, you're going to start in this mastermind. Now I'm going to upgrade you to, 10x and then 3x, and it never stops. The mastermind, I agree with you 100%. I think it's a complete accelerant for your investment, no matter what level you're at. It gives you like the confidence because then you look around at the other people and you're like, well, I mean, all these people are doing and they're just all just like me, like regular. That's real estate investing. I think some people come to it, think like everybody's special or different. Like it's not. Read The Millionaire Next Door. It's like people in like tennis shorts and gym, like everybody can be an investor. It's just about what you want to put in. And you find that out real quick in a mastermind when you hear, someone, you're like, hey, who's that guy? And then they have like, 190 units and they know what they're doing.
Sure.
It's very interesting.
Yeah.
I'm glad we touched on that because I think it helps people to know that you can find it at any level, new, old, and keep growing. If you're in 4 now, they all work in different ways to help you upgrade what you're doing.
Yeah, absolutely. Which ones are you in?
I run a few of my own, and then I mastermind. I have an on-market team too. So I'm in a lot of on-market and hybrid like agent investor groups as well. But because I don't travel much, I don't do some of the bigger ones that people like to go, like Abundance and stuff where they're traveling a lot because I don't travel that much. I'm like a homebody. So I run a lot of them for newer investors, which I like. And then we do in-person events, which again, I think is an accelerant. It helps like a brand new investor come to the table, meet people, find out that they can actually do this, hear from somebody who's their same age. And they're like, I have 20, I've done 20 transactions. They're like, what?
Yeah.
And they say, okay, you can do it. Awesome, Chad. Where's the best place for people to get in touch with you? Is it your website, which is csqproperties.com?
Yeah, the website's a good spot to start. And also any social media is just at CSQ Properties.
Yeah, we'll link to all those. Yeah, you do have a good amount of content out there. Do you find that social media now really helps just get out the brand more? To me, social media is just like a branding mechanism. And then it helps back it up because then they can come listen to you on the podcast and like, oh, he sounds the same as on social media. Then they meet you in real life. Oh, wait, he's the same. And I think that helps for the people who aren't, BSing their way through it all.
Yeah, absolutely. And I try to put out a lot of educational content also. I know you're the same way. I think that is just really helpful. So yeah, that's mostly what I like to do on the social media is put out more educational content and try to bring value to people, right?
Yeah. All right. Last question for you is if you could give advice to newer real estate investors in today's market, what's one thing that you would tell them based on your experience over the last 8 years?
Well, I think we kind of let the cat out of the bag, but my normal answer for that is join mastermind groups and networking, right? I mean, I was a little slow to that party, regretfully, right? I mean, I really didn't join those until I was in my 40s. And I could have saved so much time and energy if I would have started earlier.
The same.
Man, I was so frustrated with myself. So like whenever someone asks me these questions, that's what I say: masterminds and networking. Get in there and really try to learn from other people. And you don't need to do it yourself. And I'm sure you can attest to this. You live it. You got your own mastermind group. But what I found if within real estate is everybody is really, really generous with their time, with their information. They want to help out, right? It's a very much abundant mindseted group, which is a lot different than in some of my other industries I've been a part of. So that's really encouraging with real estate. And I would just encourage them to look in masterminds and networking.
Yeah, I think it's a great point. It's an easy way to connect. You have to go into it with the right mindset where you want to give as much as you receive. And I think when you do that, you can learn so much. The last thing, do you think, because I didn't get into them, I think I used to think like, oh, well, I know a lot. What do I need a mastermind for? And then I think like now, like, what an asshole. like then you go in a mastermind and you're like, oh, wait, these guys know way more than me, which is exactly what you want. Was it the same for you? I think a lot of people just are, like a little scared or think they know a lot or don't want to interact with people. And then when you do it, you're like, I can't believe I was missing out on all this.
100%. I mean, look, it's like, I got 3 master's degrees, right? Like I'm an education guy and I kick myself because I feel like I wasted so much time doing everything on my own. I didn't need to do that.
Yeah.
So 100%. I just think there's a lot to be learned there.
Yeah. No reason to reinvent the wheel. You take the wheel that others built and figure out how you want to use it, correct it for your own self. But yeah, this was great, Chad. It was great to meet you. And thanks so much for coming on the podcast.
Sounds good. Thanks, Jonathan. Appreciate it.
All right. That was episode 58 of Zen and the Art of Real Estate Investing with me, Jonathan Green, and my guest, Chad Zdenek. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.